All right, everybody. Welcome to the call. Today we've got Nick on the I guess Telegram/Zoom with us. It is Thursday, April 28th, and this is a really special treat because Nick's been a part of Whiplash's channel and our channel over at QSI for a while now, but I actually only recently, in couple days, Nick, like 4 or 5 days, learned of his background, a really, really impressive background, which I'm going to ask him to go into more detail. But Nick's been in the financial industry for, I think, over 25 years, something like that.
Yes.
Long time. And he's worked at some of the biggest investment banks in the world. Names that if I threw out there, I just kind of rattled off, everyone would definitely know exactly who I'm talking about. And so he's had the special, I guess, sneak peek in behind the curtain of all the shenanigans and the shit show that's been going on in the financial industry. And I think it's really important for us to know. I think it's really important for us to know about this and to kind of get a little bit more in depth with the details, because I feel like a lot of people, well, not a lot, every single person in this channel knows about the banking cabal, right? They know they're evil. They know they're part of the Khazarian, the mafia plans to take down, humanity and enslave us and all that kind of stuff. But I don't know how many people actually know about the details behind it and exactly what they're doing to manipulate people, manipulate money, and things of that nature. So I figured, we can have a conversation about some of the actual details. That way they really get to understand, what exactly is the Q team in the white hats? What are they fighting against right now? Because if we know what they're doing, we can also figure out, why is it that this Q plan to save the world is so important? And we can also figure out how that relates to blockchain technology, what we're doing over here in Stellar, and really just kind of help put all the pieces together a little bit better for many people. So with that being said, let's just kind of kick things off, Nick. If you can kind of share with us a brief background of your professional experience, that way people can kind of, put this context around who is Nick, what has he done, what does he know, things like that.
Sure. I started initially in 1986 at Lehman Brothers, and I basically got registered there as a broker, and we dealt with predominantly high net worth individuals, institutional clients, and at the time, in terms of the market, it was more transactional, buying positions as opposed to managing the full portfolio. So they would come in and they want to accumulate a particular stock or bond, that type of thing in size, then, we would help them facilitate that. And I was there 12 years, and I had moved over to one of the other major firms, Smith Barney, because of the fact that they were beginning actually a discretionary money management program. And that was, in terms of the 90s, that you're starting to see now more money managed types of accounts, mutual funds, personal managers that could be hired. So I wanted to be able to discretionarily handle portfolios of my clients in the same way as any other money manager would, and they had the ability there to do that. So I went there, and then I eventually moved to another firm because they had a better platform. But that was predominantly the reason that I had moved over. And throughout the whole process, I was involved with portfolio management, doing research, asset allocation, looking at diversification, comparing portfolios in terms of replication. So, I was pretty much involved with the markets directly throughout that period. So,
and in your duration, I guess kind of like at the quote unquote peak of your career, about how much AUM were you handling personally in your portfolio?
A little over 100 million.
And what is the average size, I guess, net worth of the client that you're handling to get an idea?
I would say probably individually $2 to $5 million.
Okay, perfect. And then just for the record, can you define what proprietary products or fund management is for people who are not aware of that?
You mean discretionary management?
Yes, yes, sorry.
Okay. Well, what it basically means is that a person will allow me to manage their portfolio. They'll give me a sum of money and say, I want to be involved with stocks or bonds or a combination. And it's at my discretion as to what they'll own, how much they'll own, when they buy, when they sell. So managing really all aspects without constantly getting the client's permission to do a trade in the account.
Right. Okay, thank you. So now that people kind of know your background and everything, I think, we're all itching for some of the juicy, sordid details of what you did, what the firms did, and what the industry overall did as well. And I know, some stuff you might not be able to share too much into detail, for whether there are NDAs in place or security stuff in place. Whatever you are able to share, we would love to know. And if it kind of crosses the boundary, then just let us know as well, because we definitely don't want anyone to get in trouble at the same time. But I think whatever kind of details that you can share will help to paint a picture of just the shenanigans going on.
That might take a really long time. No, I'm just kidding.
Yeah. So, and guys, when Nick and I first started talking about this, we were thinking, maybe we'll do like an hour call, maybe like an hour and a half with Q&A. If we find that it's getting a little, too far past that, and there's still a lot to talk about, then I'm completely, open to, if Nick's open to doing like a part 2 call if needed. So just kind of keep that in mind, guys. So can you kind of walk us through a couple examples? I know when we were having a brief chat before, you had mentioned things like, non-fiduciary, mutual funds, things like that. Because I remember when I was starting to learn about money management a couple of years ago, I was listening to a lot of different, YouTube videos and stuff like that. And I kept coming across people like Rich Dad Poor Dad, Robert Kiyosaki, Warren Buffett, and they would say, do not invest in mutual funds. It's actually the worst thing you can possibly do. And usually when you have a financial advisor, an FA, the first thing they do is they tell you to invest in a mutual fund. So I would love to know, in your words, for the audience, why not a mutual fund? And, what does non-fiduciary mean?
Okay. Well, first, I'll preface the whole conversation by saying that we're going into a period now with the QFS and the changes that we're not sure if there'll even be a financial services industry after. But there also is going to be a virtual stock market, so there may be a need, and bonds obviously, may be a need for financial services, but I want to make everyone aware of the shenanigans, so to speak, so that if there is a financial services business in the future, they'll know what to look for and what to be aware of. So
absolutely,
I'll preface it that way. I'm going to assume that everybody kind of knows, like you mentioned, the banking cabal and how for decades, if not centuries, they've essentially been controlling the money box, so to speak. And if you go back from when the Federal Reserve Act passed in 1913, you had them involved with not only printing money, but also monetary policy. And the first big crash we had was in 1929, and that was, in my opinion, predominantly caused by the Fed raising rates very quickly, very loose policy regarding buying stocks on margin. You only had to put up 10%, borrow 90%. Banks were doing the same thing with people's money. So that was their beginning of intervention in terms of starting to shift wealth from wealthy people over from the public to the wealthy, because there was encouragement of stocks being bought, and there was articles about everybody should own stocks and everybody can be a millionaire and so on and so forth. There was no action taken by the Fed until it was well, past the fact. So I guess that was kind of the beginning of them stepping in. And the only reason I'm going to take us up to what you would ask me, but just I want to show how it led to that point.
Yeah.
So after the crash, and I won't go too deep into that unless in the future we want to. They passed an act called Glass-Steagall, which basically said no more banks investing in the markets, and no commingling of businesses of banks and investment firms. And that lasted for a long time until the 90s, when the banking industry obviously had all lending locked up. But to expand their base of money coming into them, they decided, okay, well, we should look to get the investment side as well. So they lobbied Clinton basically in 1999, and they got the Glass-Steagall Act repealed, the Financial Modernization Act, which basically allowed banks to buy brokerage firms and to commingle their businesses. So, and at the time, Citigroup actually was in violation of Glass-Steagall already, but thanks to their friends at the Fed, they got a waiver, and they got away with it, and eventually it was passed very quickly, and then you started to see all these mergers. Citigroups with Barney, UBS with Prudential, and so on and so forth. So they basically now had the lending and the investment side for money being brought into them. And in terms of when you talked about mutual funds and fiduciary, the bottom line is this, to start, that the financial firm's interests are not the client's best interests. It's their priority is maximize revenue and income to the company. And in terms of the client, it's not necessarily at the aligned with the best interests of the clients.
Absolutely.
And some people might say, well, all companies do that. They maximize shareholder value. The difference here is that they maximize the shareholder value at your expense. Okay, so that's the big difference. So, in terms of their interest, you mentioning fiduciary. The industry has fought what was called the fiduciary rule for years and years and years. And what that rule was going to do was going to require that brokers at firms would have to, whenever recommending something, act in the client's best interest, first and foremost. Otherwise, it would be against this law. And as well, they have to disclose all the fees that were being charged on whatever they were recommending. Now, the industry fought this tooth and nail for years and years and years. You scratch your head and you say, well, if they're handling my money, don't they want to act in my best interest? No, because the firms make significant amounts of money on proprietary product. They sell their own mutual funds, they sell their own annuities, all different products that pay way, way more than going out and buying, let's say, a Fidelity mutual fund or something along those lines. So now they can act in suitability, meaning as long as it's suitable for you, the product could cost 5 times more than a similar product from another firm, but they have the right to present this to you and, charge a lot more money. So, fighting the fiduciary rule is basically saying, your best interests are not my priority. You're saying basically that my firm and our revenues are my priority. And I want to make sure I cover everything. The structure of the firms, just so you know, are geared towards gross production of the brokers, essentially. What I mean by that is that the more you produce in terms of commissions or fees or however it's done, the higher you get paid in terms of payout, and the higher up you become in the hierarchy. So if I do $1 million in gross revenue production, which is commissions, fees, and all that, I might get a title of senior vice president and get a trip to California for free, a spending account, so on and so on, regardless of how the clients of mine were doing. If I was a smaller broker, and I did a fabulous job in terms of making clients money and protecting them. And I only did, $150,000 in revenue. Probably I would get fired.
Right.
So, regardless of how the client, the structure is, the more you produce, the better you do. And that creates a conflict of interest because let's say things are kind of tight, like we saw in 2008, where, people were getting out of the market and getting destroyed in their portfolios. It might cause you to do something you really don't want to do because you don't want to get fired. You want to make sure you're making a living. So, it creates a conflict of interest between the two.
Absolutely. And for clarification's sake for the audience, making commission off your client, from what I understand, so please confirm or correct me, the client doesn't have to make money for you to make money. You can also make money off of their losses, so to speak, as well.
100%. Doesn't matter. There's a famous line in the movie. I don't know if everybody's seen the Trading Places, and the two managers basically are discussing. They say, regardless of whether the client wins or loses, Duke and Duke get their commission. That's exactly how it works. Regardless of whether the client's making money, losing money, the firm is always getting paid. So, that's definitely, and that's part of what we'll get into later on. But, also there's no requirement for education. If you're an engineer, you go to engineering school, medical school to become a doctor, architecture school to become an architect. In this business, there's no requirement education-wise. All you have to do is essentially pass the exam to get your license. And if you've had no experience whatsoever, you can go out and start recommending, investments to your clients. So, these things are all in direct conflict with the best interests of the clients. So, that's their first and foremost priority. So, and in terms of, you were talking about mutual funds or?
Yeah.
Okay.
Like, can you help to explain why mutual funds are one of the, if not the worst investment decisions?
Well, mutual funds were designed to basically create a bigger base of income for the firms because most people initially that were investing were wealthier people, people that had excess, monies to invest. And the average person, has very little above what they're paying in terms of bills and so on and so forth. So you might have a little bit, but not enough to go out and buy individual, stock positions, that type of thing. So they created this great thing called a mutual fund where they pool everybody together. And this way, even the small guy can get involved. And they basically can create a fee stream from that. And the reason it's not good, there's a multitude of reasons why mutual funds are not good. But it's mainly because it's a one-size-fits-all mentality. Mm-hmm. And, regardless of your situation, the manager's going to manage the mutual fund the way that their investment policy dictates. So, regardless of your risk tolerance, if you're conservative or aggressive, they're going to handle it the way they want. The other main problem with mutual funds is that there is no risk management in place from the standpoint of unfavorable markets. So if you want a mutual fund and the market is starting to come down like we saw in 2008, 2000, these were very, very big drops. The managers are mandated to stay fully invested through that period, or maybe 95%. So, most people think, well, I'm giving the fund my money to a manager. The manager will take care of me if the market starts to come down. No. The mutual fund manager will stay fully invested regardless. If you want to get out of the market, it's going to be up to you to call up and say, hey, sell out my mutual fund and get me out and get me into cash. So, people are under the impression that, these managers are going to put some type of risk management in place so that they don't end up getting killed. But that's not the case, as we've seen time and time again. People suffered tremendous losses, ever since I started in 1987. From there, it was just periodically constant cycles of boom, bust, that type of thing.
Right. And guys, just to reiterate, because earlier, Nick confirmed that it doesn't matter if we're losing money, because the company's going to lose money regardless. Sorry, they're gonna make money regardless. So that's why they don't care if you lose money or not. They're still winning at the end of the day. And so are mutual funds kind of like the main way for banks to make money, or are there other strategies they have that kind of screw the people over?
No, I mean, there's so many ways. I mean, the multitude. First, the biggest area where the large firms make money is in naked short. Naked short selling is basically selling a stock you don't own with the intention of buying it back at a later date. So you borrow a stock, let's say IBM, from someone, you sell it at $100. You're hoping the stock goes to $50. Well, you buy it back, give them back their shares, and then you end up getting the $50 from where you sold it versus when you bought it back. And the problem with that is that firm can do, they can do that all day long because they have the ability to borrow tremendous amounts of shares, and they're just constantly selling these shares. And I'm sure they have timing for timing purposes. They know that they can buy it back without any significant losses. But this is something that's like constantly ongoing. When you add it all up, I've seen estimates of somewhere in the vicinity of $100 trillion of profits they've taken out of the markets by doing naked short selling.
Yeah.
And you have proprietary product also, which is, again, the firms, they create their own products, and you don't see, when you have a proprietary product, you don't usually see the fees involved. It's built into the price. So, for example, an annuity, on average, probably pays somewhere between 6 and 8% in commission right off the bat, which is a huge number, just walking in the door. It takes time to make that up over a period of time. So, yeah, I mean, they have all kinds of tricks. I mean, they have many ways of taking money out of the markets and taking money out of our pockets as well.
Absolutely. And speaking of annuities, so my parents, when my brothers and I were born, our parents got us an annuity that was going to be, our little trust fund as we got older. And I finally got to see that annuity about a year and a half ago. And I found out that the money that they put into it when we were born actually was worth more than what I cashed out at. Because, over all these years and all of the fees and everything.
Because you have an insurance wrapper that's in there, that's, 1%. Then you have the initial fee, that's another 5%. Then you have management fees ongoing. And the worst part about it is that they project the annuity as, well, you get tax-free, tax-deferred income as it's growing, and then eventually, you don't have to pay. And then at the end, when you start taking it out, you end up, having to pay some taxes. So you get all that growth tax-deferred. Problem with that is that when the money comes out, let's say it's something that's stock-based or mutual fund-based as part of the growth of the annuity. So you have variable annuities. That's what that is essentially. When you take the money out, it's coming out as ordinary income, okay, which is a really much higher bracket than capital gains. So if I bought a mutual fund for 10 years and held it, didn't sell it, when I sell it, I'm paying capital gains, which is, let's say, 20%. Whereas when the annuity over a 10-year period of time, the money matures and you start taking it out, I'm paying ordinary income, which could be 39%. So, it's not really what it's portrayed to be. But people, unfortunately, they don't know. They're relying on the advice of the people they deal with. So
yeah, exactly. Yeah. And they're all in it for themselves because they're chasing the commission, or they're chasing that the promotion, or to not get fired. So they're really just not looking out for your best interest. They're looking out for their own pocket. And to go back to Naked Shorts for a quick second. I love the TV show. I haven't watched the last 2 seasons, but there's a really, really famous TV show called Billions. I'm sure many of you are familiar with it. Probably many of you have watched it before. Somebody in my family is actually, I I wouldn't say good friends, but knows, the guy that plays Bobby Axelrod. And if you watch that show, then I mean it's based on a true story. Not that everything is precise, right? There's a little liberty for TV and everything, but there are these multi-billion-dollar hedge funds out there, and they play all these kind of shenanigans. And you can see in the TV show where they might do something that is totally illegal, and they'll purposely crash the price of a company's stock so they can go and short it, just like what Nick was describing. And they don't actually get in trouble because they bought over people at the SEC or in the DA's office or other places. And so they're basically committing all this fraud. They're not getting caught, and they're all just kind of like hanging buddy with these guys afterwards instead of getting handcuffed. And oh gosh, I was on a call with Mel Carmine about 3 weeks ago or so. It was the second call that we had together. And I was detailing out how I have proof that the XRP lawsuit actually ended October 1st of last year. All the evidence out there. And, obviously we all know that everything's kind of being hamstrung out there because the White Hats are in control of it, and they can't actually release publicly the results of the lawsuit without, all the other crashes, everything else kind of happening in unison. So, we're just kind of sitting out here looking at the evidence. As I was, going through this presentation with Mel, I pulled up an article, and I can't remember the year of the article, but it's something like around 2011 or 2011 through 2014. Let's just kind of give that round ballpark. But it was an article by somebody like CNBC or whoever, like a major, mainstream news outlet. And in that article, it's talking about how the SEC, because they're in bed with all the big banks, and they have listed like Citibank and I think, I can't remember, but there were like 3 or 4, maybe 5 other banks that are listed in there, in bed with the SEC. And so they were basically buddying with one another, deleting all the evidence before the authorities can come and actually investigate it. So, I mean, that's just a small, tiny example of some of the corruption that actually happens.
Yeah, I mean, they call themselves regulators. Boy, what a great thing that a criminal organization, let's say a legitimized criminal organization, can self-govern themselves and make sure there's no shenanigans going on.
Yeah.
Why do you bring up hedge funds? Because when I first got into the business, I was, we'll call it asleep, like we talk about the Great Awakening. And I was taught by the firms on how to allocate monies, and, we hear you have to be in for long term, and the market always goes higher, and a whole bunch of mantras, basically. And what happened was I initially wasn't totally understanding. Well, I learned the business through the firms, so I assumed that what they were telling me was correct. And as time passed, I would notice that, you build up a significant amount of business, then you get a market crash, managers aren't doing anything, and you end up losing a bunch of clients. And the clients get hurt too. Then the market recovers a number of years, and all of a sudden something else happens, and you get another crash. The new people that you brought on board essentially are gone. And then it's a cycle that repeats and repeats. So finally, in 2008, after the mother of all crashes, both in real estate as well as financial markets, I started to question, saying, it can't be that we keep rebuilding, business goes away, rebuilding, people get destroyed, rebuild. So I started, we talk about research, self-research, and I said, okay, I want to research who didn't get hurt in this, in the crash of 2008, who potentially made money through that period as well. And when I did my research, it took about 4 years.
Wow.
The initial research showed that the people that benefited and made billions of dollars were all hedge funds, every single one of them. There was not one regular manager that we would say we use, portfolio manager, that was in a position of not getting hurt or making significant money. And when I said, okay, well, how did they do this? So I started to take apart their methodologies. And I was shocked to find that every single thing that we were taught in terms of how to invest was the exact opposite of what the hedge funds were doing. Okay? So they say, get in long term. They didn't get in long term. Only go long, don't go short. They didn't only go long, they would go short as well as long. Okay? Don't, over-concentrate. They would overcut. So, this is a clear example of how the elite are benefiting each other, billions and billions and billions of dollars, and the little guy, unfortunately, ends up losing his house, getting his portfolio destroyed. So, that was my epiphany, we'll call it.
Man, do as I say, not as I do.
Yeah, it's kind of disheartening. Do you think, I've been learning this for 25 years, and basically everything I've learned is not real. It's not good. It's opposite. And that's, again, the benefit of the wealthy people and the benefiting, and the little guy ends up not. So, that was kind of my turning point. I created my own methodology, and, I tried to work within the confines of large firms, but, their priority is, again, production, not the way the benefit of how well the client does. So I ended up leaving and starting my own firm, and, and that was it. But, that was really, it was really an eye-opener, unfortunately, because, you think you're doing the right thing, not knowing, but then all of a sudden you realize what the reality of the situation is.
Absolutely.
So, yeah. No, that was my epiphany, so to speak.
which I want to get into more in a little bit. I do remember that you had mentioned something about like the propaganda machine and like monthly retirement stuff. Can you talk a little bit more about that?
Yeah, I was going to go into that now,
okay.
Actually. So when the banks acquired the investment firms, okay, so now they need to create a long-term stream of income. So they needed to create a propaganda machine that would tell people how to invest, the right way to invest, and to be able to keep them in there for over a long period of time. So you had the media, you had firms, you had experts getting out there and saying, okay, well, you need to get invested in the stock market if you want to see growth for retirement. You need to basically stay in the market because, you need to be there long term and ride out the ups and downs, because the market always ends up going higher over the long term. And you need to use professional managers because you can't do it yourself. You need somebody who really knows how to navigate the markets and so on and so on. Okay, so now I'll get this slide. So I want to address first a couple of the main mantras, so to speak. So first and foremost is the market always goes higher, okay, over the longer term. So let me just pull up this. Okay, can you see me?
Yes.
Okay. All right. So does the market go up over the long term? No, actually. Yeah, it does. I guess if you can live, 150 years, eventually it'll end up getting to prior levels. But the fact is that you've had bear markets. As you can see, 1 out of every 3 years you've had a bear market.
Wow.
The average loss in the bear market was 31.6%, with 10 significant bear market losses of almost greater than 50% or more. Those happen roughly about every 10 years. Okay, and the average bear market will bottom out, roughly about a year, but not get to the former highs. So here's a couple of examples. 1901 to 1903, 41%. 06, 07, 48%. If you see 1929 into 1932, actually that's a combination.
Holy moly. Yeah.
So, you're talking very, very big numbers here. And yeah, the market may go up over time, but do we have the time to wait for it to go back up to where it was? Okay, so and this continues on all the way till now. Essentially, the last one was 2000, where we had the dot-com bubble, and it took 15 years basically to get back to even. In 1929,
wait, can you repeat that? Did you say 15 years to get back to equal? Like
back to where we were in 2000.
Oh,
it took 15 years to get back there.
Oh.
In 1929, it took 26 years for you to get back to where you were in 1929 in terms of the market.
Jeez. And
then from 1966 to 1982, it took you 16 years to get back to even, essentially, where you were. So if you add those together from 1929 to 82, in those 53 years, you were waiting 42 years out of the 53 just to get back to where you were before the drops.
Wow.
I mean, and all the while you're paying these professional management fees to, take care of you and make sure you're okay and protect you and so on and so forth. So, okay, and when we talk about markets eventually coming back, okay, well, here's the Japanese Nikkei 225. That's their largest market. Japan is one of the largest economies in the world. In 1989, their market peaked at around 39,000 and change. That was 1989. We're now in 2022, and their market is at 26,000. It's not even close to where it was back in 1989. Okay, so that's basically 33 years. You're still waiting to get back to where you were. Okay? Here's the Athens stock market. In 1998, 1999, market peaked at roughly about 5,800. Here we are in 2022, and it's at 1,000. Okay? So if you follow the old stay in the market, markets eventually come back. 33 years is a pretty long time, and still not back to that point. Okay? So, I mean, these are all meant to keep you involved and keep you in the market because you get paid when you're in the market. You don't get paid in cash. Here's our market. This was what I was saying. In 1929, we peaked. Took till 1956 to get back to where we were. Okay, here's the dot-com bubble from 2000. We peaked. It took to 2015 to get back to where we were. And here's the S&P 500, and it would basically be here. You see at the third peak. It took the same thing essentially about 14 years to get back to where we were. So, this whole, don't worry, the market always goes higher, stay in the market. Yeah, that's true. If you live biblical, lifespans like, 500-600 years, yeah, you're okay. But if you're in the midst of this and you're trying to get to retirement and you suffer one of these large drops, it takes a really long time just to get back to where you were. And if unfortunately, you're in a position where you're retiring at that point or need money, you're basically out of luck because there's no risk management that's in place. So
Jeez.
that's one of the biggest mantras. That's one of the biggest ones I have a problem with. And then you have, don't time the markets. Don't try to time the markets because you can't time the markets. Okay.
And meanwhile, they're doing it the whole time.
Well, yeah, the hedge funds and the yes, that's right. And the large firms are doing that. So let me get back to where I was here. Let's see if I have it. Okay, so here we are. This is again another mantra. Don't try to time the market. Invest long term. Because if you miss the 10 best days, and there's different versions of this, but it's essentially the same. If you miss the 10 best days per decade from 1930 till now, your return would only be 28% instead of 17,715%. All right, well, I mean, that sounds reasonable to me. I don't want to miss those days. However, let's go a little further. If you miss the 10 worst days of the market per decade, as opposed to the 10 best days, your return goes to 3,793,787%, as opposed to 17,715%. Okay, quite a bit of difference.
Yeah.
You look at both at the end column. If you were out the worst, the 10 best days per decade, and the worst, and then you still are at 27,213%. So clearly, it's better to be out of the market looking to get back in than sitting in the market looking to get out. Okay, but you only usually will see the first column, which is essentially, don't time the market because you would only make 28% instead of 17,000%. People don't hear these statistics. They only hear what the firms in the industry want them to hear.
Yeah.
So
before you go on, quick side note, since all of us are getting involved in Stellar and in different kinds of investments, it's kind of reminiscent of all these Indus coins coming out, the tokens, because they're launching the new coin, which is called an ICO, right? An initial coin offering. And that's essentially when the developer says, hey, let's just use round numbers. Let's say they have 100 trillion new tokens, and they're going to launch 50 trillion of them, and they're going to launch it at X price point. So if you've missed that first batch, well, they still have more to release at some point. Now, we don't always know what kind of price point they're going to release it at, but based on the historical record, a lot of them have been releasing them at that 2+ billion per 1XLM price point. So if you miss that first wave, not that it's guaranteed, but it's highly likely that you could catch it on the second wave or the third wave, depending on how many waves they have. So, I mean, those numbers are staggering. I've never seen those numbers before. But it just doesn't. Yeah, it just goes to show you that, guys, if you FOMO, you'll actually hurt yourself than if you just time it right based on your research and analyzing the numbers.
I'm going to get into what you mentioned as far as the tokenization and the supply as well a little bit later.
Okay.
I just want to go to the final part of the mantra that we've all been indoctrinated with. So we go on from, market always goes up long term. Don't get out of the market. You got to stay in order to be able to participate, and so on and so on. Then you can't manage your own accounts. You need professional management.
Yeah.
Okay. So let's look at professional management. Here we go. Use professional managers. Don't do it yourself. Okay. This is a 20-year period of managers versus they have what's called a benchmark, meaning a large cap manager might be compared to the S&P 500. A small cap manager might be compared to the Russell 2000. So every manager is matched up with an index, and then they are judged whether or not they're good or bad based on outperforming or underperforming. Okay? So in the 20-year period, from 2002 to 21 last year, look at the first pie chart. Okay? It says all domestic funds. 95% of all the active managers underperformed their index.
That's crazy.
95%. Okay? And, essentially the same type of percentages across the board. Okay? So this whole, you need to have a professional manager because they're going to, outperform, and they're going to be able to pick all these unique opportunities. Those are the numbers. Okay? 95% of them over the last 20 years couldn't even beat their indexes. Okay?
So if I'm hearing this correctly, Carl and Molly, who most people on the channel know, Carl's one of our admins. They had done a call for us back in I think February timeline when they were using dowsing, the pendulum dowsing, to pick his top clients, to pick his top assets to invest in. And Carl had almost a 100% hit ratio picking his clients for his sales job using dowsing, whereas over here you have professional wealth managers who are, let's see, between 78.95% up to, looks like the top one is 99.71% underperforming. So you're paying money for someone else to suck at their job. This is like
right.
a bunch of
And all
pouches.
domestic funds, the first one incorporates all of those put together. So you can look at that one and say 95% of these managers, so you're paying, between 1% and 2% for the most part, to, are basically totally underperforming their indexes.
Yeah.
Okay? So now, a person would say, well, why is that the case? They're supposed to be, professional managers and be able to, outperform their indexes. Okay, that's what I'm paying them to do. Okay, well, here's the reason: closet indexing. I don't know if many people that are watching this have heard of this term, but basically, what it is that I am an active manager. I'm compared to an index. I don't want to deviate too much from that index because if I do and I underperform significantly, I get fired. Okay? Mm-hmm. So I want to be as close as I can to the index and maybe try to beat it slightly. So what they do is they give you the impression that you're getting active management, meaning they're buying all different types of things, but they buy a whole bunch of the index at the same percentage levels as the index, the stocks in the index. And then they tweak a couple of positions here and there. And they say we're actively managing. Well, if you do that, you're definitely not going to outperform it by any means because you're talking about a couple of percent every single year. So you're positioning yourself where you're telling people you're paying me to actively manage, but you're not really actively managing. You're basically the index with a little bit of a tweak here and there. Okay, so and this is the definition. It's used to describe funds that claim to actively purchase investments will wind up with a portfolio not much different than the benchmark. Okay, so that's the reality of it, and so they've derived an income stream, a large one. People paying a lot of money, which we'll get into. You've seen the numbers at the end in terms of what the clients keep and what at our last conversation, what the clients keep versus what the firms keep.
Yeah.
So we'll get to that point. But this is the reason. So, you're coming to me and you're telling me, well, I'm giving you all these different managers, mutual funds, and those people are essentially, for the most part, matching the indexes, which you could buy for a fraction of what you would pay a manager, and you wouldn't have to do anything, you would just sit there. So, these are the things that really stick in my throat, so to speak. All of these mantras that everybody has been taught and they know, backwards and forwards, none of them are really true, essentially.
Brainwashing, guys.
That's right, exactly. Just like they did with, coronavirus and, the vaccine. It's the same thing. They're just using a different machine to brainwash versus, the only the mass media.
Absolutely.
So, that's kind of where we stand. So when we talk about markets, you have another question, or should I just continue?
Well, I did want to ask about IRAs and 401ks. I know that's a big topic for people, but I don't know if you're already covering that later on. I'll just.
Well, what in particular do you want to know about them?
Well, are they good to invest in? Is it a smart decision, or is it better for you to just do, I know there are self-directed IRAs as well and self-directed 401ks, but is it even worth it to get into them at all, or are you just better off doing everything on your own at this point?
Well, if you're at a firm and they have a plan and they contribute alongside of you, like matching contribution type of thing, then it would, more than likely be good to invest in the retirement account. Problem is also that these accounts, almost all 401k retirement account, that area is totally locked up by Vanguard, Fidelity, all the major mutual fund companies. So when you're in there, you have to pick from a mutual fund of one of them that they're recommending within the portfolio. But it still would be okay if you're getting a matching contribution from the employer. IRA, you don't get that. So
it kind of sounds like it could be more a wash though, because you're paying all these fees for the mutual fund, And you're hoping that the employer contribution is going to offset all those extra fees that you're paying. That's to me.
Well, that comes down to what you and I talked about, and that's kind of near the end, where what is the effect of the fees within that you don't see because they don't disclose that. What is the effect on the overall returns of the portfolio?
Yeah.
So that's definitely, but at least you're getting something to offset it versus
nothing.
In an IRA, I mean, you're contributing yourself to get a tax write-off, but and you're getting tax deferred growth. So I mean I would say it's kind of better in a way because you're able to control your own destiny and do what you want to do in the IRA itself. But I don't know when we have no income taxes in the future, based on Sarah, if there'll be even a need for IRAs or these tax deferred accounts.
Right.
Because that's the basis of what people. What's that?
There's nothing to defer.
Right, that's right. So I mean, for the time being, I guess you get a benefit out of tax deferred growth. But, in the case of the corporate 401ks and things of that it's the net result is probably negative versus positive. So, that's essentially it.
Yeah. Yeah. Crazy.
Yeah.
All right.
You want me to continue? Or
no. Can you continue?
Okay. So, I want to look at, we have to, especially in what's happening in the tokens, we want to know what the drivers of the markets are. And since the beginning of the markets, the two main drivers have been fear and greed.
Mm-hmm.
Those are the things that end up driving decisions, in terms of people making decisions on what they're doing. On the greed side, it usually is, let me see, I should have a slide. Okay.
It's interesting that you say fear and greed is driving the market because I don't know if you were on the call earlier today. I'm sure you're probably at work, Nick. But today at noon Central Time, Annie and I had done a call, and it was like 50% of the call, or maybe 30-40% of the call. It was a big chunk of our 2.5 hour call, or however long it was precisely about the fact that, we all know that people have consciousness challenges, but we just learned yesterday, because of this constellation work that we were doing, that money itself, as in this inanimate object, also has consciousness problems as well. So we talked about that in the call, and a lot of that was driven by the fact that we are, like we were talking about earlier, we're brainwashed to have certain patterns of thinking, and your thinking results in behavior and actions. And so, whether it's FOMOing into our lobster wallet for these, seller assets or other kinds of investments, they could be RV currencies or bonds or whatever it is. It's all based on fear, right? Fear that we're going to miss out, or fear that I don't have enough, I need more. Or that greedy nature, like Annie talked about, the mercenary nature, the consciousness rather. And it was in short, the idea that you're doing something for you as opposed to service for others. So, fear and greed, I mean, that's just been so pervasive today. It's insane. So sorry, I didn't mean to interrupt. Please.
No, it's okay. That's been, and the fear that you're speaking of, fear of missing out, is actually the greed component, because you don't want to miss the opportunity to make a lot of money.
Yeah.
So, that's where you start. And this chart pretty much perfectly, shows how the mentality goes. Because it's usually, when you're doing the greed side of it, and you even saw this, as you said, with the tokens, where I have to get more, I have to get more, I have to get more, I have to get more. Okay? And I don't want to get into a higher price. And so you look at this chart and you see the markets, heading higher. And, people start to get very optimistic. And they say, stocks are going to continue higher. And this is a great market. I'm going to keep putting more money. And then, excuse me, you peak at the investor all-in. That's basically everybody has come into the market and they've committed significant amounts of money. Then the market has its usual topping out. There's just really nobody else to step in and and buy, essentially. And our friend Al, if you see at the bottom, this was the dot-com crash of 2000. Our friend at the Federal Reserve, Alan Greenspan, mutters two words, we think that there's irrational exuberance in the markets. Well, that was that. From that point on, the market started to drop because they felt, the Fed is going to start tightening. And many people were overextended on margin, same type of scenario that you always see. So you got a big downswing, and it was very, very painful for those that had no risk management in place, meaning they had no exit points, along the way, or maybe hedges on the portfolio. So if you look, and when you come down, it says investors cash out. Okay? So that's when the market bottoms. Everybody says, I can't take it anymore. This is too painful. I'm going to lose everything. Get me out. Get me out. Soon as they do that, it's always a bottom for the most part. And then the market starts to work its way higher again. Mm-hmm. Okay? And in this case, this kind of leads to 2008, because when this drop was happening, people were losing fortunes of money in their financial assets. But the Fed started lowering rates, and that created inflation in their real estate assets. Okay, so you got to bounce back. People start to get optimistic. They start getting back in. Boom. Lehman Brothers, real estate market, financial crisis. And you end up getting another tremendous crash. People, again, these are devastating moves. It doesn't look like much on the chart, but when you're talking about, stocks like AIG going from 100 to $1, okay, brokerage firm stocks going to zero that were, $80, $90. You're talking about multitudes of money. Mm-hmm. Once again, when you hit that point, people, it's a proven fact that people will always sell at the bottom and always get in at the top, because the greed is driving the top part of it, and the fear part of losing everything drives the cashing out part of it. So this is a cycle that's repeated itself. Now, bear in mind that as this is happening on the beginning part of this, where stocks are going, the managers are collecting their money all the way as they're going along, collecting their money every year. They're not leaving it in there. They're taking it out. 2%, 2%, 2%. So they've collected quite a bit of money before you get to the peak of investors all in. Then the market goes down. On the way down, there's also collecting money while people are losing a bunch of money. So all the way through, you're getting these peaks, valleys. And this is a regular pattern that you'll see, as I showed in the beginning, that you have a bear market once every 3 years. So they're collecting a whole bunch of money throughout this period. But is the investor getting anything? Not in this case. Like I said, it took 15 years for you to get back to where you were. And that's not net of fees. It probably took even longer. You might not even be there in terms of where we are now.
Seriously.
So, it's a great business for them to be, collecting money, whether you're losing money, like you said, or making money. All the way along these cycles, they're basically collecting money. So, knowing that they can influence people with fear and greed, because that's how they base their decisions, you say, can markets be manipulated? Okay, now this is a list of the NASDAQ 100, the top 100 companies in the NASDAQ Composite Exchange, the index. Okay, if you look, the top 10 companies. Do we see any names that are familiar to us in terms of Kabol people? Microsoft, Amazon, Tesla, Alphabet, Apple, okay? These are the biggest stocks. These top 10 stocks control 50% of the movement of the whole entire NASDAQ market. Just those 10 stocks, okay? Now, we know who has all the money, obviously. It's the Vanguards and the BlackRocks and tremendous amounts of money. So they're the drivers of these markets. And, of course, you have the Bill Gateses, the Jeff Bezoses, and Eric Schmidt. They have tons of money as well. Okay? So that's the NASDAQ. You also have the S&P 500. Same names. Apple, Microsoft, Amazon, Alphabet, Tesla, same names. Berkshire, our friend Warren Buffett, who says he holds long term, but he doesn't actually do that in many cases. Okay, so you see the same names that control. The S&P is not as bad. It's about 30% of the market, but that's still significant. Okay.
Yeah.
The Dow Jones. Dow Jones probably shouldn't even look at the Dow Jones because it's only 30 stocks, but it's the same type of thing in terms of the top part of the chain. The largest companies control a majority of the movement.
Yeah.
So if you look at the trading, how trading has evolved, it used to be that individual people did a lot of trading, institutions did a lot of trading. We are now at the point where 90% of all the volume that you see on the stock exchanges is institutional. So there's virtually very minimal of you and I buying stocks. It's all institutional money. So knowing what we know in terms of what we saw with the NASDAQ, 50% of the movement, S&P 30% of the movement. If you want to make a market move, there's more than ample money to be able to do that. Okay? So you see these peaks and valleys and peaks and valleys. It's kind of collect the fees on the way up. Okay, now we start to go down. Let's bring it back down again. Okay, now we go back up. And
a roller coaster.
So what effect, what effect will this have? This is where you and I talked about.
Oh, before you get to this slide, can you
Yes.
go back to the peaks and valleys slide for a quick second?
Yeah, sure.
Okay, so as you were talking about this, I was thinking about, how does it affect us and some of the conversation I've been having in the last couple of days. But it's obviously because all of us here on the call and the channel, we are familiar with the cabal, not just the banking cabal, but the media cabal and the political cabal and all of those as well. And we know they're all in cahoots with one another. And then we also know that there's a big psychological game on top of it too, because everything at this point is a psyops. Q is a psyops too, right? If people tell you that Q is not a psyop, or they're trying to say it to scare you, that's also part of a psyop, because all a psyop is, it's literally the term for psychological operation. That means it's a term for psychology. If you are a psychologist, you're doing psyop on your patient, okay? So it's neither good nor bad. It's literally just a strategy. So as I'm putting things together, and I had thought about this before, but I guess I haven't, delved in this stuff for quite some time. But it's looking at these peaks and valleys and knowing that the funds, or the firms, the hedge funds, et cetera, all the shops, they're making money regardless of if we're making money or losing money. It then makes sense where we also have confirmation that these big shops can manipulate things, right? Because they've got buddies over at the SEC, they got buddies over at the DOJ and other places in the media.
They have lots and lots of money.
Yeah. So they can buy all these people off and say, hey, it's time, the price is starting to go up, so it's time for a short. And I can imagine those wheels are turning background going, okay, Nick, here's the deal. We're about to, initiate a massive sell-off. So let's prepare all the news articles out there, and we'll all time everything in a coordinated strike, and then we'll crash it so we can short sell. And then as everybody's panicking, they're all selling out, then it's all right, now let's initiate the buy-in. So it's people are always, 2, 5, 10 steps behind them because everything's been manipulated from a coordinated attack against us.
Yeah, and bear in mind, when you know how a person's going to behave at a particular point, and you can manipulate the points, then you know what's going to happen. And if you start to drive the markets up, that people are going to go into the fear of missing out mentality.
Yeah. And
they're going to start putting in money. I got to get in before it keeps going higher. So they know that. So as their portfolio gets bigger, their fees get bigger on the way up. Then, near the peak, they have the friends at the Federal Reserve who control monetary policy. So if they tighten monetary policy, that constricts, growth and so on and so forth. that will cause a contraction. That is usually when markets crash or come down and correct. Okay? So they know, and then so they step in and they say, okay, irrational exuberance, as Greenspan says. So now that triggers a huge sell-off. People start to lose their money. You get to the fear part of it where I'm going to lose everything. And they end up cashing out at the bottom. Like you said, now they know the people, the general public is cashed out. Time to step in, turn spigots on, and start to buy. So, and this cycle repeats itself, and all through this cycle, they're collecting money. So, they have all the tools to do it, and particularly Federal Reserve has a lot of influence on the markets, obviously. Mm-hmm. Okay? And they have the ability to just keep this merry-go-round going on and on and on, and, just siphoning money out of people's pockets.
Yeah.
So.
Yeah. Crazy.
Yeah, it's not when you realize what's really happening, it's not a pleasant picture, so to speak.
Yeah. All right. So please continue to that slide, because that slide blew my mind.
Okay. So we say, what is the effect? You have this merry-go-round going on. This is probably the most important set of slides that you'll want to pay attention to. This was just an example of, when you have these peaks and valleys that they're collecting money on the way up and on the way down for a very, very long period of time. Okay? So let's see, where am I here? Uh-oh, sorry. Where am I?
Wrong direction?
Yeah, I want to see. Hold on, just bear with me a second. I would put it in there.
If you don't have it, I do have that little.
I know I had put it in there. So no, hold on a second. I apologize.
No worries. Yeah, when Nick and I were having a little pre-call, gosh, 4 or 5 days ago, I only saw I think you showed me 5 slides, so I haven't seen all the information that you have. But these two, the one that we're looking for right now, are the two that really it pissed me off. They were the ones that I was like, this has got to be on. Whatever you choose to talk about, you got to talk about these two.
Yeah, just bear with me a second. I should just go to the file itself. I have the files. I know I added it in, so I don't know why. It's
and I can show them if needed as well, because I have
I have. I know I have it here. So let me just see if I have. Let me just go to the drive itself.
So while you're looking for those files, I posted this in the channel, I want to say over the weekend. I kind of, get lost in my days. But last week, there were a couple of people that reached out to me on LinkedIn. And you guys might remember the post that I made. But there was one guy from, I think it's either BlackRock or Blackstone. And the other one is from a big VC firm out in Silicon Valley. And they specialize in the crypto stuff, the NFT stuff, basically blockchain style of investments. And they were, some of the first to get into all of the major technology companies that everybody is aware of. But as I was talking to them over the weekend, and we're just kind of shooting some messages back and forth, I was trying to educate them on ISO 20022 and things of that nature, and what is Stellar, because all of these guys, they really only know about Bitcoin and Ethereum. They don't really know anything else. And they're over there telling me, oh, we've got all these crazy algorithms, and I don't even have to lift a finger. All I have to do is calculate the percentage return that I want to make, and you put that into the algorithm, and it'll tell you when to buy in and when to cash out. So that's why they don't care if it's going up or if the price is going down, because they're going to make money either direction. And I know there's also possibilities, I think through options or something like that, where if it's going sideways, meaning the price is just kind of doing this thing and it's not really going anywhere, that sideways momentum, you can also make money on that as well, but only if you know how to. So,
Okay.
yeah, go ahead.
You can see this, correct?
No, not yet.
Okay. What do I do here? Do you see my screen or no?
No.
Okay.
I can pull it up. Which one?
You can do that. Yeah, that's fine. That's fine.
Do you want me to pull up the bar chart or the graph one?
Pull up the graph one first, and then the bar one.
Okay.
We'll do that after.
Okay.
I can't believe it. I know I had it on. Yeah, I edited it today, actually.
No worries. I got it up on my screen.
Okay. All right.